Hey everyone, this is Frank Ochoa, aka Pivot Boss, and what I wanted to do in this video was basically give you a look at what happened in the crude oil chart during Friday's trading, January 30th, 2015. It was a wild day of action here where basically we saw an incredible short squeeze, and basically we saw what we were talking about in the previous evening when I gave my analysis to our premium members. I gave them a 5-minute video that basically dissected the levels to watch for and opened the possibility for a big time short squeeze back into 48s. And you can see here, this is from the end of day playbook that I provided our premium members, and basically this was provided Thursday after the close for Friday's trading, and it's basically saying right here, this is the key level to watch, is the previous week's close and low. Above that level likely squeezes bears into 48, which is MC VPOC. That's value. So I was saying right here, bulls are still defending 44.20s for a shot at squeezing bears through 45s and into MC VPOC at 48. Obviously, the overall downtrend had been in effect, and the bears were seeking downside price discovery, but right here, those late sellers got scared, they got trapped, and then they sparked a short squeeze back to 48. So let's take a look at what happened in the actual chart. So if we take a look at how the chart played out, this is the daily time frame now, which is the bar that was added is right here, January 30th. And this is the bar we were talking about where late sellers below 44.20 became stuck. And then right here, bears were attempting to hold price below the previous week's low, 45.17s, but then when they failed, a big time short squeeze ensued into 48. That type of run right there, where you're basically going 4 points, that's a 4-point range for the day, 4.03 to be exact. It's been averaging a 10-day average, including this day, 2.5 points per day. So that's 158, 160% of average daily range. Just a huge, huge move. And it came right back to our MC VPOC, which has been part of our overall commentary regarding the recent decline. Obviously, we mentioned that any pullback to 48s is likely going to be defended by bears for a shot at pushing this thing lower. So let's look at how this thing played out in the intraday time frame, because this is really where you're going to see a lot of the analysis really shine. So if we take a look at the intraday time frame of crude, if I bring this thing back out a little bit, this is what the view I showed our premium members last evening. And the range that I was focusing on, and still am, is the range that spans from 44.68 up to this high at 51.72. And that's the key range. That key range was developed during the second week of January, and the midpoint of that range became 48.20. And you can see here, the first thing I said about this range is that bears are defending price levels above the midpoint, and bulls are failing to gain traction or acceptance above that zone, and that implies a move back to the lower boundary with a shot at a downside break. And we saw this thing play out the entire way. Look at how the inner 25% key level became an important level. This is the midpoint of the range, this is the upper 25%, and this is the edge of the range. So these became the very, very important levels that we've been watching in premium for our analysis in crude oil. And what I mentioned last evening were these sellers right here, these sellers coming in below 44.68. That's below the bottom of the range. Those sellers right there were key, because anybody that comes in at the bottom of that range needs to get paid. If not, where are their stops? Their stops are up here. So if they fail to get paid and you start to get stopped out as a seller, you have to buy to cover. And those buys came out and a short squeeze ensued, and you saw a rally right back to the middle of the range at 48.20 and right back to MC VPOC at 48 evens. And that's right where sellers came in and defended despite a $4 rally up, still defended at those highs and pushed price back down $1 back to 47s. It was an impressive move, but it all came about because of this key range that I marked in January 2 weeks ago. I mean, this was a key range we've been following the entire time, and I talked about how these guys right here, they failed to establish acceptance below that low. Failed range expansion usually leads to a move across the range, at least to the center point, and oftentimes to the opposite edge of the range. So those failed range expansion opportunities that you see, whether above the top of the range or below the bottom of the range, can oftentimes lead to moves, just like what we saw today in crude oil. It's one of the most important concepts of trading that you'll come across. Failed range expansion, especially below the bottom of the range, leads to a short squeeze up. Failed range expansion above the top of a range leads to a big time slam and a long liquidation down. And this is what happened today. So after you saw price squeeze out of this thing, now let's drop down into an execution time frame. My execution time frame is either the 500 contract or 1000 contract volume bar chart. Here's a 1000 contract volume bar chart. And the thing that is usually something that you notice about this when you're down into this time frame is you're able to really identify those times when large volume orders come in. So anytime if you're using a volume bar chart, look at this right here. You see those little dots right there? That means that an order came in that was greater than 1000 contracts, or whatever order came in at that block of time is greater than that. So you only get a couple of dots and you move on to the next one. That's when you know big volume is coming out. Big volume is coming out. And depending upon if those are buy side or sell side, that gives you implications on what's happening in price. We'll get to that in a moment inside a footprint chart. But over here, early in the session, this is overnight trading. Price is basically coiling up. But once price pushes through the top of the overnight range and then the top of the early morning range, it became support right here. And that's when you started to see the first signs of a squeeze. When you see the first signs of a squeeze out of a tightly congested range, it's often suggested that you just pop on some moving averages and then you start to buy the pullbacks to the trigger zone for new highs. And that's exactly the approach I took today. So right here you can see the numerous buy the pullbacks, buy the dips that occurred after the first squeeze from a very tightly congested range. Look at the first pullback to between the first and second moving average. That's what I call the trigger zone. That's where you buy for new highs. The trigger zone, that's where you buy for new highs. And once price reached 48s, that was basically my target, 48s. So once I watched to see what happened up here, this is what happened. I saw price pop up to a high, and then I saw a huge buy imbalance come in, and I saw it immediately go offered. So that's all happening basically right here. So if we drop into a footprint chart, this is the footprint chart that I was watching. And if we scroll back in time, let's scroll back and find those 48. There it is. This is what I saw right here. So price pops up. This is the rally. So here's 48 evens. This is the first time it's trading it. Sell imbalance gets stuck right on it. You squeeze it out. Look at all the buyers that came out right here, and especially the buy imbalance right here. That buy imbalance went offered, as indicated by this range bar chart and the red next to it, went offered. That means buyers came in and they didn't get paid, so now the stops, the sell stops are coming out. Sell stops are coming out, right? The other thing that I saw was right here. This is VPOC. VPOC shifts up to 48.21. That's a VPOC shift up from way down below. And when VPOC shifted up, it immediately went offered. So those were the two things that I saw immediately that led me to believe that there was going to be an after-hours sell-off in crude oil. And from right there, you can see how price then begins to sell off dramatically, and then we see a move back toward 47s all the way down until price, basically bottoms out above 47 on the pullback. But that sequence of events, so now if we go back to the intraday chart, that sequence of events helped identify what was going on here. We knew that this is 48s. We knew this is the center of the range at 48.20. Price attempted to hold above the top of the key range, right? Above the center of that range, and failed. Failed range expansion leads to rejection and a reversal, and that's what happened late in the day, and you can see how price followed through on that move. The other thing right here, this is the VPOC shift up. You see VPOC shift way up on the big balance, the big sell imbalances, immediately goes offered. That's telling you right there that once value shifted higher, value is basically the most volume that's traded there, the most market participants that change hand, the most volume there. If value goes offered, that's the market telling you that price is considered too expensive, and that's when the sell-off ensues. So those were the key points today in crude oil. It was a wild day with a 4-point range. Look at the resulting move here, by the way. It was a 1-point sell-off. This is 48.35, and this is 47.15. So basically $1.20 after this sequence of events occurred. So typically speaking, when I see a 4-point range in crude up, you're not looking to sell it, but reactions start to kick in when you see things as traders, like buy imbalances going offered and then VPOC shift ups going offered. Those things right there are just intuitive. It's an innate trader thing that you just begin to get as a trader after seeing it for so long, and you can switch course like a robot and start selling this thing. Because when the market is active and volatility is flowing, that's the time to make money, and this was certainly one of those days in crude oil. So I wanted to let you know all the various things from my perspective that I saw with regards to crude oil today. If you're not a premium member, you got to be a premium member. I mean, it's the best membership that you'll get for futures analysis anywhere around. Again, this is analysis that I've been providing, and we had a squeeze locked and loaded for today. As a matter of fact, I made the premium video available to you, which you can watch directly from this post. That video will show you 5 minutes of analysis before it happens the next day. And this is the analysis I provide every single day to my premium members. I post 6 days a week tirelessly. If you're not a premium member, you can get a 2-week trial. So just go to pivotboss.com, 2-week trial up here. You can also go to premium content and check out the Getting Started with Premium section. We also have a brand new resource library with market delta charts. It's always evolving here at Pivot Boss, and it's all to provide better education, better training, better charts for traders. So thanks a lot for watching this video, and give me your feedback and your thoughts.